Hi, everyone. I'm glad you're here with me. I'm Laird Nasuli. I'm the CEO of iEmergent. And just like last year, I'm going to go over some high-level insights that we have started to garner and gather with the 2023 HMDA data. I'm going to only touch on a few. I don't know if you remember last year, I didn't know that I only had a half hour, and I had probably an hour and a half's worth of things to talk about and got stopped right in the middle. So I decided to keep it high level today and just really go over with you and even leave some time for questions about some of the trends that we are seeing and what those ramifications might be. And then obviously moving forward, what else are we going to keep talking about and learning about? Because as usual, the HMDA data is extremely valuable, really rich for about, and really important for about 12 months. So once it gets too far beyond, it's a little bit more challenging. I'm going to check the chat to make sure. Okay, thank you. All right. So it's no surprise to anyone that the market in 2023 went down even more from 2022. So if you look at this graph that I have on here, this chart, this is more than 2 decades of loan unit originations, both purchase and refi. So the dark blue is purchase, the lighter blue is refi. And this is showing sort of the long-term trending for what's happened with top end originations at a national level. As you can see, we had our 2020 and 2021 in terms of units, still slightly smaller than our record-breaking 2005. Now, when we look at the dollars, you'll see that that's changes. But you can see that that these really are outliers. They're not the norm. They're not going to be the norm. And so when you look at 2022 and you look at 2023, yes, 2023 was a very small year, but you can't really think about it in terms of 2020 and 2021. And I think that's one of the things that makes us, so alarmed and concerned when you have a major drop like that. I mean, it's a 60% drop from 2021 to 2022. And then about a 30% drop to 2023. So that's just something to keep in mind. So the year ended up at about 4.5 million originations, if you look at purchase and refi. And I did add our forecast for this year and next year into this chart, just so you can see that we're not projecting that it's going to go down anymore. I think that 2023 with the higher interest rates, increasing home values and all these other factors that we have going on, sort of a fatigue from 2020 and 2021. I think this is going to be the bottom, 2023, 2024. And then moving forward, we're going to start seeing an uptick both in purchase and, eventually in refi. So let's see how I don't know why this isn't turning. I think I'll have to do it like this. Okay, so then same thing if you look at the 2024 to 2025 originations. Here's where you see that massiveness of 2020 and 2021. Not only were there a lot of units, we also have really high average loan sizes. So that drop still really significant, very painful from 2021 to 2022. Almost entirely driven by refi. And then you can see again, though, the drop from 2022 to 2023, driven both by purchase and a huge drop in refi, but driven by purchase too. So certainly, again, we start looking at the forecast moving up. So this is what it is. It's been a tough year. It does show why lenders and in our industry has felt kind of constrained for the last 2 years. One of the interesting things that we've looked at, though, is, and this is going to impact product and which lenders are, in the top market share. One thing we have seen, though, with the change in rate, we've seen a resurgence of home improvement and other purpose loans. particularly a significant number of open-end loans, as households are using HELOCs rather than cash-out refis, for a lot of different things. And so that has shifted, and it changes the overall mix of which lenders are at the top when you look at the full originations picture. But if you look just at this alone, you'll see that in 2020 and 2021, if you look at all originations, including home improvement and other, refi was 61% of the originations in 2020, 58%, dropped down to 31, only to 19 in 2023. But you can see that there is also an increase proportionately, obviously in purchase, but also in the other two, in the home improvement and in the other range. They're almost the same width, the bars. So that is something that's noticeable. It's an additional 30% of the originations are coming from those two other categories. And where that really plays out is in who the lenders that are doing business are. And so I'm going to dig into this. There's quite a bit on this in the next 2 slides. One of the interesting things that I found is I was expecting to see a drop in the number of reporting lenders in HMDA because of the consolidations that we've been seeing and things like that with the IMBs. And rather than see that, I saw an increase. So at the end of 2022, there were 4,385 HMDA reporters. At the end of 23, they reported 4,993 lenders reported at least one application. And of course, with the different requirements and thresholds, that's not every lender who originated a loan. Those are those that fall under or above the threshold. But of those, this is what's interesting. You see that 21% from account perspective in 2022, 906 were IMBs. That percentage shrunk to 17% to only 871. So a lot of this, I was assuming this drop, but instead we see an increase, but an increase driven almost entirely by increases in, from a lender count in credit union and bank depositories. And if you look closely at those whole originations, you'll see that a lot of that is because some of the lenders who weren't necessarily doing enough reportable loans are because of the HELOCs and the home equity and the home improvement loans. And so that's sort of how that, has kind of played out and made it a little bit different. Like you see here, if you look at home improvement loans by lender type, 1% of the loans, home improvement loans are originated by IMBs. And then 2% this year, other, which is really going to be, your HELOC and other open-ended lines of credit. Versus if you look at purchase and refi, 62% and 64% this year of all loans closed by IMBs. So that 17% in 2023 drove 64% of the purchase business and 47% of the refi business. I think that's interesting because it does show when you start looking at it later on, when we look at what products are there, it does show why, potentially why, IMBs had a bigger share of the market, especially when you start looking at government product and things like that. And I'm going to stop and check here. I know that there's a chat. Okay, that was just perfect. So moving on, I obviously, because I'm spending time on, I really like these charts because they're not only about the number of IMBs, it's about the business, and it's also about that mix. And so going back to what I was saying, if you look at in 2022, overall, 52% of the business was purchase. Now, again, when we think purchase and refi, we're usually looking at the purchase percent of purchase and refi, but we're looking at the big picture here, the whole. And so 52% of all loans were purchased across the market, 26% of those to credit unions, 45% for banks, and 65% of IMB business was purchase. So if you think about that, that explains why the number of IMBs, even though it's smaller, is driving so much more purchase business. I mean, I just think that that's a really interesting statistic. And when you look at it here, it's the same as the other charts we were looking at, but it really shows you just from a, and this right here is not count, this is loans. This shows you how many more loans there were and how that was impacted and distributed between different lenders. So, so that's just another slide about that. So when you think about that, then I just brought in, again, at the national level, looking at who the top lenders are in both, you know, combined dollars and in purchase dollars. Oh no, this is markets. I'm sorry, it's not it's the wrong one. I want this one. You bring in and look at who the top lenders are. If you think about that mix and purchase, you can see that another thing that's, I think, starting to change, but it hasn't just been in the most recent years. But I think it's been over, we're actually doing an analysis to see how long this has been happening. But more and more of the purchase market of the top 30 are IMBs. So you can see here in the past, you know, we had Wells up front. A lot of the big banks were some of our largest purchase lenders. And now it's really dominated by the IMBs, you know. And if you look at that number 9, the bank that's at the top of the purchase loan ranking list is JP Morgan, so Chase. And then only, you know, a handful, 1, 2, 3, 4, 6 other banks even made it into the top 30, and only Navy Federal made it in as a credit union. And so, you know, looking at this, these sheets show us what their rank in 2022 was, you know, who dropped percentage points. But you know, this really is speaking to the fact that, you know, in certain environments, in different rate environments, in different types of business, whether it's business that's coming, you know, like receiving business, or, you know, hunting and gathering and sourcing business, it makes sense that IMBs are kind of out there with a more aggressive sourcing opportunity and are more, I don't want to say aggressive, but are utilizing, you know, the government products a little bit more than lenders are, than banks and credit unions are. When we look at the top, you know, the high end market of what is out there from a dollars and loans perspective at that national level, if we go back and, you know, when we're looking at this and looking at these are nice to knows, but really in terms of everybody's doing business and you being able to utilize data to do things, this level of data really is too macro. And so, you know, if we were to look at and say, okay, well, how does that break down when we start looking market by market? You know, whether we're looking at purchase loans, purchase dollars, average loan size, you know, Black, Hispanic, jumbo, conforming, every market is different than any other market. And so being able to share the analysis that I'm doing at a national level, at a metro market, at a county, even down to a census tract level of detail, is really where you're going to get insights in HMDA that are relevant to your business. You know, you can spend hours going over each of the different pieces. But what I like about this is, you know, I do like the charts because it quantifies the number, but I like the maps because it's easy to flip back and forth to see the difference in ranking. You know, red, when we have the maps, red symbolizes, in this particular case, it's the CVSAs, the metro areas with the most loans, and the blue are those with fewer, so kind of hot and cold idea. You can look at this and you know, you see the big markets. But I think it's really interesting if I pop over to look at the same thing by dollars, it changes. A lot of the ones that were top markets for units like Chicago, Houston, when you look at dollars, they drop out of the top and come into like tier 2, tier 3 markets. And you can see Seattle pops up and goes up higher in terms of, you know, which category it's in. And the reason I like the maps is, again, go from that to this, but it's explained by that. And this is important because a lot of affordability right now and your strategies, when you add in average loan size, purchase price, and interest rates, that's our perfect storm for why we have this drop. It's a challenging time, and you can see those markets where the home value to income ratio is, over 4 and 5. They're very tough markets to buy in. And I guess in some respects, then it becomes a tough market for everyone, for lenders who are trying to serve everyone. So if you see here, the reds here, that's San Francisco, these oranges, these are markets where the average purchase loan size is, between $1 million, it's over $1 million in the San Francisco area, but then, over 870,000. So, huge loans that are for properties that, if we're starting to think about, and we're going to look in a little bit at the penetration rates by race and ethnicity, or LMIT, LMIB, that's a problem because it really impedes the ability of certain cohorts of applicants to actually originate, and get a home. So I did want to, before we dive into the race and ethnicity, and any of you know me, that's my favorite part to talk about. I did want to show this, though, because I think it's interesting how the increase, how much of a jump there was in government lending from, even from 2022 to 2023. 2022 total, FHA, VA, and FSA, 23.8%, so just under 24%. That jumped 3 percentage points to 27 in units, and about another 3.4%. I guess it's 4.4% in dollars. So that's significant. Really, really big jump there. And I do think that that's part of the reason why you see the IMBs, sort of dominating the purchase market a little bit. They just do have more product that fits this structure when you're looking at purchase and refi. Again, when you're going and looking at, open-ended loans and home improvement, then that, of course, is the opposite. Excuse me. So I wanted to look a little bit at, and here, before I move on, I just wanted to show these graphs too. When I sent this, this is great to look at because it gives you the numbers, but this just shows you that bump where you can see really for the first, it doesn't happen very often, but you can see that bump up here in government, driven mainly by a bump in FHA, slight increase in VA, FSA is flat, but really it's that FHA increase that's driving the increase in government lending. So one of the things that is important, and one of the major trends that we always look at, is what does it look like from the perspective of not just penetration rate with the diverse households, with BIPOC households, with LMIT, with LMIB, but what does it look like from a loan application action standpoint? And the reason this is really relevant, 2 reasons. One is obviously from a compliance perspective, it's important to be thinking about this. We know about redlining. We know that it's a major priority for the Department of Justice. We know that CRA modernization's around the corner. We know that this is important, but if we also look at demographics, these same borrower pools, these same groups are also driving future growth. And so this is a problem that's not just about housing equity, it's a problem also about lender growth. And I think that's something to keep in mind, and a reason to really dive in to things like, what is our fallout? What does our pull through look like at a product and purpose level? And then, which I'm going to show a little bit, what do the denial reasons look like? Why aren't we getting why is there not more pull through? And so when you look at this, this is one of my favorite charts because of the green is, it's very easy to look at this just visually. The green is go, green is good. green are the originated loans. And you can see that those lines are very different between different groups. So, almost 70%, again, overall US purchase origination rate for non-Hispanic whites. Contrast that with 56.7% nationally origination rate for Black households or Black applicants. That's a huge gap. We talk about the homeownership gap. This is one of the two places this starts. It starts on an application, a redlining kind of marketing standpoint where not enough apps are coming from Black and Hispanic and BIPOC households. But the other side of that, not enough loans are being generated from the applications that are given. So you can see that that's the widest spread with Black. Second, low to moderate income borrowers, just actually 3.1 percentage points higher origination rate, which is really still low. But it's astounding to me that that's such a wide difference. That just speaks to inequity so clearly. And then you look also, so you've got that 69.8%, Asian much closer, almost 66, the overall 66.3, BIPOC and minority as a whole, about 62%. So that's the good, that's the go. But when you look over here, denial rates have increased, but more alarmingly, and we'll look at this in like year over year, so have withdrawals and incompletions. And the unbooked piece is a little different, but a lot of our lenders, when we're doing sort of a analysis of what from a fair lending perspective, but also just looking at how well they're serving their neighborhoods, denial rate is what we always think is the best judge of that. Well, we're seeing more and more that withdrawal rate is really picking up. And so if you think about strategies that would decrease that, it's either potentially loan officers are kind of counseling potential applicants out before there's an adverse action, before a denial, or what I think is in a lot of cases, and with incompletions, borrowers are starting or applicants are starting on the journey. They haven't had enough education. So there's something that happens that's a sort of a roadblock that in the end keeps them from having, from becoming a homeowner or originating a loan. And so those are what these add up to. So you can see here that the flip side of that 56.7 is a 43.3% fallout rate. That's really, really high. And if I look historically at specifically fallout in 2023 by borrower groups, you can see that it's at an all-time high. So fallout now for all minorities is up to 38.3%, and driven not the most by denials, but by the withdrawals. So I think that's something to think about. And if you're looking at your data and your HMDA, that's something I would pay attention to because I think it's pretty important. Again, just another way to look at the same thing. This one allows you to kind of see it all stacked and how it relates. This one allows you to see each year which groups have the highest fallout. And it's no surprise, it's increasing, but Black applicants have the highest fallout. And obviously the light gray here, the non-Hispanic white applicants have the lowest fallout. Here's why it's important from a growth perspective. You can also see here, the top chart is showing Asian, Black, Hispanic, Native American, and Pacific Islander loans and dollars year over year. So the two blue ones here are Asian, red, Black, yellow. And you watch it go from like, here's 2018, here's 2019. You take that same look though and look down here, you see that the penetration rate, which is the percent of total purchase loans that are, Asian, Black, Hispanic, that's increasing and increasing quickly, especially with Hispanic borrowers. If you're not lending successfully with this space, this tells me it's really time to take it seriously, because that's the biggest bump that we've seen really ever in 1 year in terms of both dollars and loans. So Hispanic borrowers, it's no shock that it's a top opportunity, but just how much of an opportunity that is, despite the fact that there were still lower denial, withdrawal, and completion rates, just speaks to the strength of that market for the future. I mentioned the denial rates, and another analysis that we're doing over the last 10 years. The biggest shift that we've seen for every group is that now every single cohort, whether it's borrowers or like a tracked cohort like MMCT, the number one denial reason, and we calculate this by looking at denial reasons 1 and 2. And so what percent of, the times does that show? DTI, really driving that. When you look market by market, you'll see that there are places where collateral, insufficient cash have a bigger issue, are a bigger part of it, but DTI is driving most of it. Still credit, but DTI by far has become the number one denial reason. And I think what's exciting and good about that is that this kind of information is really where you can start looking at lender and community, programs and plans and solutions to start driving that. It's harder when you're dealing with employment. That's harder for a lender to start working on solutions that would mitigate that problem. But in this particular case, DTI, collateral down, cash, those are things that I think if we are really innovative, we can start thinking about where things are headed and moving forward. So I know I went quickly through this, and I would love to dig in and look at different markets. And I think I actually do have, here's the market. So you can see here, I showed you on the map, but this is sort of the quantification of that. If we were to do the same ranking for Black, Hispanic, Asian, those lists would change pretty dramatically. And I hope we get to take a part 2 like we did last year, where I can really dive into that and move away from the aggregate national message and start looking at individual markets and individual segments. And Amy, it is exactly 1:31. And if Tony Bramley's not on this call, she would be shocked to know that for once I finished on time.
I was just going to let you go, but no, I do appreciate you considering the time. And let's absolutely follow up and do some extra or additional webinars that can kind of dive into, I think, didn't we break it up by the 4 different regions, right? So we did.
Yep. And one thing I didn't get to this time is I did the same analysis for TMC lenders only. And it's very interesting. And you can see that, I basically looked at it as a subset, and I would love to have the time to dig in more. This is a really quick and dirty overview, but yeah. But it just shows me where we want to dig in more. And hopefully, in the next 2 weeks, we will. And just an FYI for anyone who's listening, we have all of, ranking reports, share reports. If you're interested in getting that, at any level for MMCTs in any way, shape, or form, let me know. And, we have reports, we have shorter term, quarterly access to MarketSmart, just different things available for people who just want to utilize what we have for HMDA alone. But as you can see, I'll talk about it for hours if you let me.
Well, so to everybody on the call, look out for those follow-up webinars. We certainly will have Laird come back again and drill down into your specific region to get some more information. But Laird, are you going to share this presentation deck with me to provide to everyone on the call?
Yeah, I am. I have a couple slides that I don't know where they went, but I'm going to add them back in.
Okay.
That's
All
what
right,
happens when you
awesome.
go from one to the next. So I'll send that, and then, I'll also make sure that contact info is in there if anyone wants to ask me about any other metrics or anything in particular. I'll always field these questions. I love to talk about this.
Perfect. We appreciate you so much. Everyone on the call, I will send out the follow-up email, which will have the recording of this call as well as this presentation deck. And if we can get it together, hopefully the links to each individual regional call. But if not, certainly check our member event calendar because they will be posted there. And we will also put them out in our weekly TMC Connect newsletter promoting them. So keep your eyes out on those. And in the meantime, if you have any questions for Laird, you can shoot them over to me, or you'll have her email in the follow-up as well. Thanks everybody for joining us today. Thank you, Laird, as always, for all of your amazing insights. This data is super useful and we appreciate all your hard work.
So exciting to look at it now. All right, we'll talk to you guys. Have a great
Thanks
rest of your
everyone.
day.
Have a great day.
Bye-bye.
Bye.